how to lower your tax bracket. Hi, I'm Candice Cane. I'm a tax advisor here at Robert Hall & Associates. Today we're going to talk about how to lower your tax bracket. We're going to cover income shifting, timing of income and deductions, and also deferral of your taxable income. As always, subscribe to our channel for tips and tricks, and let's jump right in. So if you want to lower your tax bracket, you need to lower your taxable income. To get to your taxable income, you're going to have your deductions first. So you take all of your income and then you subtract your deductions. Usually people will have itemized deductions, and those are in the categories of medical, charity, taxes, and mortgage interest. Once you understand what you can deduct, you can try to maximize those deductions to reduce that taxable income and get yourself into the lower bracket. Just remember that taxes are maxed at $10,000. So between your income that you pay to your state, your income tax to the state, and your property tax and any fees or taxes that you pay besides that, you want to get up to a $10,000. After that, it's not going to do you any good. So you want to maximize that $10,000 for taxes. Mortgage interest, there's not a lot you can do to time your mortgage interest. It is when it is. If you can make an extra payment before the end of the year, you might be able to get that interest on this calendar year. If that makes a difference in a tax bracket, it'd be worth it. Charity. Now, charity, you can definitely time your charitable contributions. So look at what would make a difference and maybe get that charity in before the end of the year. Or if it's not going to make a difference this year, delay it until next year and work on getting you into that tax bracket next year. Medical expenses. Now that's one where you're either going to have it or you're not. There's not much you can do to change those. But let's talk about your income. When are you getting your income? Can you change that? Can you defer that? Possibly you can defer it with a retirement account. A person, one individual, can defer up to $68,000 a year if you have all the options. Most people on a W-2 income can defer their income to a 401k plan, and that's usually about $24,000 a year that you can reduce your taxable income. Also, if you're self-employed, you might have the option of a SEP account or an IRA account. There are several different ways to defer income in a tax-deferred account towards your retirement. The other thing we were talking about is maybe splitting or separating your income. If you have a company or a business, maybe you have somebody else working in the business that's in a lower tax bracket. Say you hire your child who's in college. They're 25 years old and they work for you. Maybe you pay them a little bit and their tax bracket is lower than yours. You get some of that income out of your bracket and into someone else's bracket. That's how you can get to lower your tax bracket. Still have more questions or want to have a one-on-one consultation with one of our tax advisors? Click the link in the description below and contact us for those things.